Hello everyone, it's Davide here and welcome back to Learning Finance. Look at that, guys. Today it's a crazy Monday, okay? What the hell is happening here? The market has opened in a crazy way, okay? The Carnival Corporation's up almost 13% and everything is going up, okay? Everything is going up. Norwegian Cruise Line almost 16%, okay? 16%. Look at that, how it's going. That's incredible. That's incredible. And Royal Caribbean as well, almost plus 17%, okay? Insane. So, what we do today, we go through some fundamentals of those three stocks to see how bad the situation is and which one has the most likelihood to survive. Okay, so leave me a like if you find this video interesting and please subscribe to the channel and let's begin. Alright guys, so here we are. The three cruise stocks, okay? Carnival Cruise, Royal Caribbean, and NCL Norwegian, okay? CCL, RCL, and NCLH. And let's take a look. So in 2020, we have a high of $51.94 for Carnival, 135.32 for Royal Caribbean, and Norwegian 59.78. And the low, look at that, absolutely distraction, okay, with the Rona situation and lockdowns and things like that, distraction, okay. We have minus almost 85% on Carnival Cruise, minus 85.77 on Royal, and almost minus 88.24 on Norwegian, okay, Norwegian. Absolutely devastated, okay, incredible. And let's take a look, because now, of course, a lot of people, they say, well, those stocks are undervalued and probably they're gonna go back, but let's see how it is the situation in a fundamental way, okay? How the balance sheets of those companies, how much debt they have, and how is likely that they will go bankrupt. Okay, so let's take a look. Revenues, guys. Revenues. From the revenues, we know Carnival Cruise is the biggest one, and Norwegian is the smallest one. Okay, Royal is in the middle. Profits. We have margins. Okay, look at the margins. And in terms of cost of revenues margins, we have the Royal Caribbean is the best. Okay, is the best. The gross margins, higher it is, better it is. And with almost 45% of gross margins, Royal Caribbean is the best. Followed by Norwegian. Okay, Carnival Cruise is the worst in that particular margins. When we go through operating margins, we have again the Royal Caribbean is the best, okay, followed by Norwegian. And again, Carnival Cruise, the worst. Net margin, the same, okay, the same. Royal Caribbean looks like is the best in terms of margins, okay. Let's take a look now at probably the most important part, okay, the health of those companies in terms of balance sheets, okay, assets versus liabilities. This is the last balance sheets that have been issued in the end of March. Okay, so these are from the first quarter of 2020. And we have for Carnival total current assets of 2.8 billion, while total current liabilities of 10.7 billion. Current ratio 0.27. Absolutely ridiculous, and bear in mind it's the best of the three, okay. This is crazy, guys. This is very bad, but we know that, okay, we know that. It's not a good situation for those guys, and it's a risky bet. Okay, it's a very risky bet in a very risky environment right now, with this black swan event that has happened, and that's very bad for everyone. Uh, Royal Caribbean, 0.15 of current ratio, absolutely ridiculous, and at 0.20 for Norwegian. We have, while in the total assets and total liabilities, we have that the best one is Carnival Cruise. Again, total assets divided by total liabilities of 1.76, which is not bad. Okay, it's not bad. Let's say it's not bad. While the other ones, well, not too much less. We have 1.67 for Royal Caribbean and 1.64 for Norwegian. And debt to equity ratio, the best one is Carnival Cruise again, below 100%, 90.77%. And in that one, I considered also the last debt, okay, that they have issued. So I considered those things, okay, as well. And I added them to the data because those things were not already included in the Q1 balance sheet, okay. So 2 billions for Norwegian, and we have a 60.25 billion for Carnival Cruise back in the beginning of April, of which 4 of them are in debt at 11% the interest rate, which is 11.5. Absolutely insane to be paid in 2023. Okay, so it's not very long term. And the other two, they have debt which is above 100%. So yeah, as we know, it's bad. Okay, it's bad. We cannot deny that. Okay, we cannot deny that. Market cap, here we have almost 9.6 billion for Carnival and 7.3 billions for Royal Caribbean and 2.7 for Norwegian. A book to value, which gives us an undervaluation of, at the moment, minus 52% for Carnival, minus 39 for Royal Caribbean, and minus 57 for Norwegian. Now, what is the point? Okay, what is the point? Of those three companies, none of them will have a bailout. Okay, that's the point. Because, for example, for Carnival Cruise, the US government said that basically you are not based in US, so why should I help you? Okay, so it's not like the airlines that they are being helped by the government, but in that case, no. Okay, you have to do with what you have. Okay, so that's why it is risky, and it is very risky also because cruises. You go on a cruise because you want to go on holiday. Okay, while comparing with airplanes, sometimes you have to fly because you need to, because you have to do something, because even work related. Okay, so it's not just for holidays. That's why probably the airplane business, it can start before that the cruise industry. Okay, but anyway, those things, they especially for Carnival Cruise, which is the biggest one, it operates all around the world. Okay, so from their side, they have, let's say, a geographic diversification. Okay, so probably they can benefit from the fact that in other countries they are gonna start sooner than others. Okay, so let's see how it goes. The bet is simple. It's a very risky bet. I admit that I have some Carnival Cruise stocks. I bought them around $15 per share. It's not a big position, okay? It's in my risky part of the portfolio, where I have this one and I have also American Airlines. It's a position in my portfolio which, if I lose everything, I don't care. It's a super high risk, super high return part of my portfolio, which is of course small comparing to the rest of the portfolio. Okay, it's like high risk, high return. You know that it's very risky. You know that bankruptcy is likely, but you know if they survive, of course, it's gonna be a higher return bet comparing to other safer stocks. Okay, so that's it, guys. Those are the numbers. Current ratio, absolutely ridiculous, ridiculous. If you don't have a bailout here, it's very super risky. Okay, it's very, very, very risky. And those guys, they are issuing debt at a super high yields. It's like they want to survive this year, they want to survive in 2020, and they are gonna risk it all for the next couple of years. Okay, because you have to give it back in 2023. Okay, so it's like I'm gonna survive now and let's see what happens later. It's like live day by day and don't worry about tomorrow. Okay, so that's their mentality right now. It's trying to survive. And let's see how it goes, guys. I repeat, very risky bet. Okay, very risky industry. If they are able to make it through, well, wonderful, wonderful. Okay, but don't put 50% of your portfolio in that industry. Okay, because it's very likely that they could go bankrupt. Okay. So this is the end of the video, guys. I hope it's interesting for you, and leave me a like and leave me a comment below. Tell me what you are doing in this crazy Monday, and see you in another video, guys. Bye.